Sarah, as you said, markets are turning around after that higher than expected November payroll number and the drop in unemployment this morning, 4-month low. That move caused a move up in the 10-year, as you said, as investors worry a bit about higher for longer. Joining us live here at Goldman Sachs trading floor in Lower Manhattan is the co-head of global banking and markets, Ashok Varadhan. Ashok, thanks for having us, for hosting us. It's great to have you.
Yeah, thanks for coming down here and not making me come to the studio.
It's a long walk. So let's talk about the batch of data, not just today, mission jobs, but even the things we got from JOLTS earlier in the week. Is the market right to second guess some of these things?
I think it's pretty Goldilocks. I think if you're sitting there and you're the Federal Reserve and you look at the pace of incoming data, you're getting kind of what you wanted, which is, certainly job openings are coming down, but you're still having job creation. And so you don't have, growth will continue to hang in there because the U.S. economy is continuing to create jobs. But that's happening at a time in which, the contemporaneous rate of inflation is coming down and coming down very nicely.
The House view at Goldman has been constructive all year.
Yes.
And that's worked. You were below consensus odds of recession. I think you're back to 15%. What did those who questioned the resilience of the economy at the beginning of the year, what did they miss?
I'd say a couple of things. I'd say one, appreciating sort of how well household balance sheets sort of came into 2023, I think was a big, the initial conditions were really good. And then also ongoing fiscal support. I think, obviously, we continue to sort of run deficits in the $1.7 trillion, a year, and that's providing, ongoing support for the underlying economy. And I think the combination of those two things led to probably more resilience than anyone would have forecasted and allowed people to basically absorb, these higher policy rates.
But now we're at a point where fiscal spending is a big part of the conversation. And even you guys have argued you'll wind up with some normalization at the front end, but maybe not as much relief at the long end because we're still worried about entitlements and a bunch of other stuff, right?
Yeah, it's hard to see the fiscal picture improving, at any point over the near term when you think about the amount of outlays that go for debt service, the amount of outlays that go for entitlements, the amount of outlays that go for defense spending. Those aren't things that you would necessarily predict that that policymakers would pull back on. And so obviously, fiscal concerns, are out there and remain. That being said, I think there is the capacity for rates to come lower in the front end.
And that's what makes, in Goldman's view, a soft landing easier in 24 maybe than it was in 23, because there is that pocket of available cuts should you need them. Is that fair?
Yeah, I think if you look at the Fed's, sort of dual mandate, which is, full employment coupled with price stability, I think they're getting, really good readings in both areas. And so what that does is that allows them more flexibility.
You think the rally has bought Treasury some time? Is pressure eased off on Treasury?
I don't think the rally has bought Treasury some time. I think ultimately what might, alleviate some pressure for Treasury is if short rates come down a little bit. Obviously, the cost of financing is very linked to where the policy rate is. They
were having a discussion at the top of the hour about whether this recent rally in equities was banking heavily on early cuts. Markets looking for 100 basis points, double the Fed's own expectations. Are they asking for too much?
I don't think they're asking for too much. I think there's probably whatever you want to call it, a risk premium. I think, given the fact that I think the market consensus is that the next move is going to be an ease. The question is when and how much. And so the market will always put a little bit more out there than maybe what the forecast is. Our forecast, the trading desk's consensus forecast next week is that when the Fed publishes its summary of economic projections, it'll predict, it'll forecast, a median of 2 cuts in the latter half of 2024. That's sort of where we are as a desk.